All right, it's taking us till the 10th chapter to get to corporations, which is probably the most widely known business entity, but here we are. Don't forget to read the chapter Objectives on your own. And one of the reasons that corporations are so well known is that they make about 85% of all the money from all the different business entities. So even though there's probably more, in fact I know there are more sole proprietorships than corporations, by far the corporations make a lot more money. So rights are rights that are afforded to artificial people. And they're very similar to a lot of the rights that are allowed a natural person that we've discussed before, the difference between the two. So a corporation can sue and be sued, it can own property in its name, it can make charitable donations, mortgage property, enter into contracts, lend money, have business. So a lot of the things that you and I can do, an artificial person such as a corporation can do as well. And this entity is completely separate from the shareholders. Alright, so before a corporation starts, people usually get together and plan on how they're going to start it. So the people that start a corporation are called a promoter, or promoters. And they raise money to start the corporation. They find everybody, shareholders, directors, managers, employees. They can even drop a business plan and decide where the corporation should be located. And where the corporation is located can make a huge difference. Different states have different corporate laws, so that can make a huge difference. But just where a business is located in general can make a huge business. One thing that Starbucks did was that they kind of opened up in the same neighborhood as other coffee shops, and it kind of was unfair because they kind of just used the idea that there's a coffee shop here, so this area will support a coffee shop. But corporate headquarters can be in a different state than where the company operates. And so a lot of companies will incorporate in Delaware because it's very pro-incorporation. And how pro-corporation the state is makes a big, huge difference. And Delaware is known for being so corporation-friendly. They have all sorts of things that they do to get people to come and incorporate in their state because they need the revenue. They don't have a lot of natural resources, so that's kind of one of the things they do for revenue. So as the promoter is getting a business started and ready, they're liable for the contracts that they make until the corporation basically takes them over. And once the corporation takes over the contract, they take it over to the original signing date. So, like we mentioned, Delaware is a very good place for most companies to incorporate. We're also seeing now that Nevada is a great state out west if a company does not want to go national. It protects against being taken over. It has limited liability for directors. Like a limited liability company, they don't have to have assets to start. And there's not corporate state income tax for corporations that aren't doing business in Delaware. So they made it very, very positive. But the number one reason for a corporation to incorporate in Delaware is the pro-corporation laws there. So they're very corporate friendly. The courts rule on behalf of corporations quite a bit. And still, yet more reasons is like a LLC can be owned anonymously. They don't have to have their meetings in Delaware. And if you think it doesn't matter, it does. A lot of times attorneys will miss a filing date in the state of California, and then they'll sell their clients on Delaware and get it in by 9 o'clock Pacific Standard Time via fax. Alright, so a corporation can be one person, or thousands of people. And one of the nice benefits of it is it can sell stock to raise money. Now, one of the most important things that a paralegal can do is preserve the name and keep it the same name in all 50 states. Name brand recognition sells. You know, a lot of businesses are not named the same across the country. Carl's Jr. versus Hardee's, Soup Plantation versus Sweet Tomatoes. When I was helping Target as one of their many attorneys, they would do a holding company just to reserve the name Target in the states that they were planning to move in to, especially in the Deep South, which was mainly very pro-Walmart. There is a ton of stuff that has to go in the Articles of Incorporation because it might be a stock corporation. And the corporation does not actually exist until the Articles of Incorporation are filed. And there's more reporting than with any other type of business entity. Now let's talk about preemptive rights. So if we have a stock corporation, it's basically a right of first refusal. So a shareholder, Brian, owns 1,000 shares, and this equals 10% ownership in Widgets. 10 times 1,000 means that there are currently 10,000 shares in Widgets. If Widget issues 10,000 more shares, we want to know how many more Brian is allowed to buy. So 10 current shares plus 10 newly issued shares equals 20,000 total shares. So, but Brian has preemptive rights, so he would get to buy another 1,000 shares. And the 1,000 current shares owned by Brian, and the 1,000 more shares he buys using his preemptive rights, he has a total of 2,000 shares. So 2,000 divided by 20,000 is still 10%. And why does Brian care? It does not dilute his ownership interest. So he's still a big player in this company, and because he owns 10%, he gets a lot more notice and information than other shareholders. All right, the promoters often have a meeting with the incorporators of the corporation. There's a lot of prep and planning that goes into forming a corporation. So they have what's known as an organizational meeting. And they're going to come up with all sorts of things like articles of incorporation, ratifying contracts, coming up with those directors and officers, adopting bylaws, going ahead with stock, determining where to bank, how they will do their accounting, and going ahead and actually issuing that stock. Now, a closed corporation is a special type of corporation, and it's kind of the antithesis of the big publicly traded corporation usually. It's typically a family corporation, and it's not publicly traded, and it could have a stock, but it is owned by the family. Now, the stock has to indicate it is closed because it can only be sold to insiders. There's no board of directors, bylaws, and there's no formalized meetings. There's not even minutes required. This is really the friends and family plan is what I like to call it. And typically, you can't have more than 50 people, and they go ahead and run the business. It's just real informal, and you have to sell to people within the corporation. Closed corporations are formed very similarly. You do articles of incorporation, but they don't have to have bylaws. All the shareholders are involved, and a real true lack of formalities. Now we're back to the private document, and the bylaws are going to have a ton of information in them as well because stockholders want to be able to see that and know what's going on with their investments. There's going to be a lot of duplicate information from the Articles of Incorporation as well. It will go into a lot of detail about shareholders' meetings, what is proper notice for those meetings. It'll talk about date, time, and place for special and regular meetings. It'll talk about how a special meeting can be called. It'll discuss what a quorum is. In the state of California, a quorum is usually a minimum of 1/3. They don't do more than that typically because it's so hard to get a quorum. It will also talk about when can the shareholders go ahead and view the financial records, all the rules about voting. So there's going to be very long, probably 25, 30-page document at least for all the bylaws for a company. Now, in the bylaws, it'll also go over the directors. How many should we have? How long can they serve? What are the requirements for them to be elected directors? Now, they can go ahead and appoint the officers. The officers work at the request of the directors, can be fired by the directors. Directors are elected, but officers are appointed by the directors. And it'll talk about whether or not the directors can be held liable for different acts that they commit or not. And will they be indemnified? Will they have insurance? How much will they be paid? When can they be removed? And corporations have to usually insure and agree to pay lawsuits on behalf of the directors in order to get anybody to serve. It's a job with tremendous liability, so they have to kind of agree to take over that liability. Now that's fine as long as the director is an honest director, but we've seen a lot of issues since the economy went down with directors really abusing their power and the corporation indemnifies them. That's a problem. All right, the private document still we're on the bylaws, and it also is going to have officers. So the main four parts of bylaws are shareholders, directors, officers, and the shares. And officers will have titles like president, vice president, treasurer, and they have specific things that they're supposed to accomplish, and they usually get paid. The fourth item in the bylaws is all about the stocks. So everything everyone needs to know about stocks pretty much needs to be in the bylaws. All right, so how does a corporation go ahead and get its money? It can either be raised through stock or it can be borrowed. And stock is good in that it does not cause a debt that the corporation owes. So some corporations prefer it, and usually they do common stock, and there's all sorts of rights that come, like the right to profits or dividends, selling rights, liquidation rights, voting rights, changing it from common to a different type. And so there's a lot of rights that come with stock, and stock holders typically have their rights pretty well protected. All right, consideration for stock. So almost anything can be used to buy stock. Cash, personal assets, like a car could be traded for it, home could be traded for it, people could borrow money, and a lot of people were borrowing money to buy stocks, and then if the stock went down, that was a major problem because then they were losing a lot of money, and then they still owed the money for the stock. Sometimes people can get it as part of their compensation. Qualcomm has been a very big player in this in San Diego. Par value is really going away, so we're going to skip over that. That's more for you to read on your own. Now, most stocks no longer have an actual physical paper certificate unless they're Disney stock. People still like to get Disney stock certificates because they have all the cute animal characters on them. Typically, it's all done by computer now, but it will still tell you quite a bit of information when you buy a stock. And these are some of the requirements that must be disclosed to people buying stock. And stock is typically very easy to buy and sell unless it's that closed stock we were talking about earlier. There can be several different classes and types of stock. For example, there can be common versus preferred. Preferred is more like a bond. It gets paid back first. But most people can afford common, so that's more common, haha. All right, debt financing is another way that somebody can go ahead and get money for the corporation. They can borrow money. Now, that means that they owe interest, and that can be problematic, except the federal government has made it very lucrative to borrow money, so you can deduct interest, which is why a lot of companies do go into debt. Okay, we're going to skip this slide. All right, going on to this one. Shareholders usually want the company to go into more debt because if the company issues more shares and shareholders don't have preemptive rights, then their ownership interest can go down. So in the example we were doing above, where the guy got 1,000 more shares, if he didn't get 1,000 more shares, his ownership interest would have gone down to 5%. He wouldn't have had the same rights. So he wants to see the company go into debt instead of issuing more shares. And issuing shares is not tax deductible. All right, and then read the case on your own.